The reason why billionaires fund my deals and why they won't fund yours has almost nothing to do with how good your deal is. I've raised billions of dollars for investors that include individual investors, billionaires, family offices, and even sovereign wealth funds. I've built a private equity firm that became the 6th fastest growing company in the country. And before that, I managed over $10 trillion in assets at BlackRock, and I've advised JPMorgan. And here's what most operators completely miss. Billionaires don't fund deals, they fund systems. So if you're polishing a pitch deck to present one opportunity, then you're playing a different game than the people who are writing $25+ million checks are playing. Because ultra wealthy people and institutional capital are not looking for a great deal. They're looking for a repeatable machine. And there are 4 rules that determine whether billionaire money flows to you or flows past you. So let's break them down. The first shift you have to understand is this. Billionaires think like portfolio managers, not deal hunters. Most operators, they come to the table excited about one opportunity, one apartment building, one development, one off-market acquisition, and they walk in and say things like, this is a great deal. But institutional investors don't think that way. They're not asking, is this property good? Instead, they're asking, how does this operator help me allocate capital across a sector over the next 5 to 10 years? When I was at BlackRock, we almost never evaluated single assets in isolation. Instead, we evaluated sector exposure. We asked ourselves questions like, who can consistently source opportunities? Who can execute across cycles? Who has infrastructure? And who can deploy capital at scale? These kinds of investors don't evaluate your $5 million or $25 million building, because on a scale of billions or even trillions of dollars, a few million bucks is barely even a rounding error. So instead, they evaluate whether you can systematically find and execute $5 million or $25 million buildings again and again and again, and through different market conditions. That's the mental shift you have to make, because you're not selling a deal. You're selling your ability to become the reliable capital deployment vehicle in your respective niche. And that's why you'll even see operators with lower predicted returns get funded, while someone else with a perfect 20% or higher IRR struggle to raise even a single dollar, because that first operator has a system and that second operator has just a moment. But billionaire capital doesn't chase moments, it backs infrastructure. And if you internalize that, then everything changes. Now, once you understand that big investors are evaluating systems and not deals, you start to see the filters that they're running behind the scenes. And there are 4 main ones. And most operators, they fail the first one before their deck even gets opened. And that first filter is deployment capacity. Can you actually absorb $25 million, $50 million, $100 million or more? And here's the key part, without breaking. If I give you $30 million tomorrow, do your operations expand smoothly, or do they implode and collapse under their own weight? Institutional investors are not interested in writing 5 different $5 million checks to 5 different sponsors if they can avoid it. They would rather write one single larger check to someone who can actually deploy it efficiently. But if your back office, acquisitions team, reporting systems, compliance structure, and asset management platform aren't built for scale, then you don't pass this filter. And frankly, most people just simply don't. Now, the second filter they use is market position. Are you uniquely positioned to see deal flow before it hits the broader market? Do brokers call you first? Do relationships bring you opportunities quietly? Do you have an angle that gives you proprietary access or some kind of edge? Because if you're sourcing deals the same way that everyone else is, via LoopNet, blast emails, and competitive bidding, then you don't really have an edge. You're just an average operator, and institutional capital does not like to pay for average access. Now moving on, the third filter that larger investors use is risk mitigation. And this is where amateurs get exposed. You see, most operators, they say, we did our due diligence, and they think that that's good enough. But that's not risk mitigation. You see, real institutional conversations are about downside protection on a structural level. How is the deal insulated if rates move, if rents stall, if liquidity dries up, or if cap rates expand? They want to know what breaks first and how do you prevent it. Now, to be clear, they're not looking for deals without risk. That's obviously not real. They're looking for operators who understand risk in layers and build in buffers deliberately. So now let's move on to talk about the fourth filter, which is exit optionality. Does this investment have multiple paths to liquidity, or does everything depend on perfect conditions and perfect market timing? If your entire strategy requires selling into a hot market 5 years from now, that's not optionality. That's hope. And let me give you a real example here. I was recently talking with a colleague of mine who was raising capital in a space where competitors were offering nearly 20% annual returns and still struggling to raise money. But my friend, he was offering investors a much smaller 6%. And yes, you heard that right, 6%, okay? It sounds crazy, right? Well, guess what? He was raising $750 million every year like clockwork. That's almost $1 billion annually. How was he able to do that? Because he proved that he had a reliable system for sourcing and operating deals at scale. And just as important, his structure also offered multiple exit opportunities that others didn't. So investors who gave him money weren't just betting on a single outcome, they had options. And this structure worked so well that Blackstone ended up acquiring his entire company. And this was all possible not because of a flashy return projection, but rather because of the machine behind his offer. And these 4 filters eliminate the majority of opportunities before anyone even thinks to debate about your underwriting assumptions. And most operators, they never even realize that they're being filtered out. Now, here's where things get uncomfortable. Your perfect pitch deck might actually be disqualifying you. You see, Billionaire Capital does not move through cold presentations. It moves through relationship networks, through referrals, and through long-term pattern recognition. So if you're obsessing over making the deal look flawless, then you're signaling that you don't understand how capital allocation actually works at scale. The more you say things like, this deal has no risk, the more sophisticated investors assume that you just don't see the real risks that are there inevitably. And institutional conversations don't start with, here's my best opportunity, check it out. Instead, they start with something more like, here's my pipeline, here's my sourcing engine, here's my operational structure, and here's how we deploy capital repeatedly. That's why as sponsors grow, they often naturally shift from individual deals to working through funds. And this isn't just a legal structure change, it is a shift in positioning, because you're now no longer asking for money for one specific property, and instead, you're presenting a system that can absorb multiple properties and deploy capital continuously. And when that happens, the fundraising conversation changes completely. It becomes less about convincing someone your deal is perfect and more about demonstrating that your process is durable and scalable. Now look, most operators will watch this video and still go out and pitch individual deals to larger investors and billionaires, and they'll polish slides, they'll highlight project returns, and they'll chase meetings, and they'll keep wondering why the big checks never end up coming. But if you actually want to position yourself the way institutional capital thinks, if you want to build the kind of system that passes these filters, I'm doing free strategy calls this week where I'll walk you through how to architect all of this properly. Click the link below and let's get you funded the right way. Because once you understand how this game really works, you can't unsee it and will never want to play small again. So let's recap things clearly. Billionaires fund systems, not individual deals. And they screen through 4 filters. Can you deploy serious capital without breaking? Do you have structural market access? Have you engineered real downside protection? And are there multiple exit paths? If you fail any of those quietly, the money will flow right past you and not to you. And the core shift you need to make is this. Stop thinking like a deal finder and start thinking like a capital deployment system. You're not competing with other deals out there. Instead, you're competing with other operators who have built more scalable, more durable machines. And here's the part that most people don't realize. There is more billionaire capital looking for reliable operators than there are reliable operators capable of absorbing it. There is literally right now more money today sitting on the sidelines waiting to be deployed than there has ever been in all of history. So the bottleneck to your growth isn't a lack of money, it's structure. While everyone else is still begging for meetings with individual investors, you now understand how billionaire capital actually moves. And if you want me to personally walk you through building your own capitalized deployment system and positioning yourself for institutional money, then book a free strategy call using the link below this video. This is the same approach that I use to raise billions of dollars, and it works whether you're doing your first deal or your 50th. And if you want to see exactly how to structure these systems step by step, watch How to Start a Real Estate Fund from Scratch step by step. In that video, we break down the operational framework that makes everything we talk about today actually work. Because once you stop pitching deals and you start building systems, then you stop chasing capital and capital starts chasing you.